We have a question here from Sakim saying that he really wants some more information about what type of things can affect the oil market, and not only from a FX point of view, but also from a more commodity trading point of view. So, just on this, it is important to note, Sakim, that our specialization is more on the FX side, not in commodities. But of course, as part of our intermarket analysis, we do need to stay up to speed with the developments of the oil market, as it can affect the petrocurrencies like the CAD, the ruble, and the NOK. So let's break it down into a few chunks, Sakim, just to make sure that we get to all the important points. The most significant and most important factor affecting oil prices can be split into four different areas. So the first one would be the global economy. We also have geopolitics, OPEC, and then the weather. Of course, the overall overarching theme for all of this is always going to be how it affects the overall supply and demand of the oil market. So the general idea of supply and demand is probably something you already know. The idea is that when there is more supply of something versus its demand, or in other words, there is more oil in the market compared to what is actually needed, that usually leads to a reduction in oil prices, and vice versa. If there is less supply for oil versus its demands, in other words, there is less oil in the market compared to what is actually needed, that usually leads to an increase in oil prices. But keep in mind, the market is forward-looking in nature, right? So even just the rumor of a supply and demand imbalance will be enough to move oil prices. So the market doesn't suddenly wake up one day, and suddenly sees, oh boy, okay, there's too much supply compared to demand, and suddenly, start selling oil. They will of course be forward looking in nature, so they will try and anticipate possible future supply and demand shifts, and of course trade oil prices accordingly. So our job is to try and ascertain what type of things can affect the market's expectations for supply and demand imbalances in the oil market. So the first one, and probably the most important and the most influential one, is of course OPEC. So OPEC is short for the Organization of Petroleum Exporting Countries. Now, it normally consists, I think, of 14 countries, of which the largest one is Saudi Arabia. And it's basically a consortium that aims to keep oil prices balanced by influencing the supply side, or let's say the production side of oil. So what's important to note and interesting to know is that the world's biggest oil producers, which is US and Russia, they're not actually part of OPEC. But recently, from 2016, OPEC has partnered with countries like Russia, which is known as OPEC Plus, which basically aims to influence a bigger part of the production in order to have a more meaningful impact on prices. So how can we gauge OPEC and OPEC Plus from a trading point of view? Again, comes back to supply and demand. So when there is lesser demand compared to supply, or in other words, too much oil being produced, OPEC will aim to put in place production cuts across its members in order to rebalance the supply and demand imbalance, which should push the price higher. That is exactly what happened a few weeks ago in May 2020, when we had the biggest drop in oil prices in history, due to the massive demand shock coming into the world economy due to the coronavirus pandemic. And what we saw OPEC Plus coming out with a new deal or a new production cut, trying to actually revive oil prices. Now, the funny thing is they were actually partly the part of the cause for the big drop in oil, because at the same time that we had the massive global demand oil shock, we also had Saudi Arabia and Russia going into an oil price war with each other, which obviously gave another reason for oil prices to move lower. So, looking at OPEC, that's obviously going to be one of the more overarching themes, because that's really a big part of the overall supply and demand dynamics. But that also brings us nicely to the second one, which is the global economy. So the global economy needs oil to operate. So when the global economy is booming, there's more growth, there's more expansion, means there's more mobility, which requires more oil. So, another factor that oil traders will look at is the overall health of the global economy. And again, the reason why this is important is it comes back to supply and demand once again. When there is more demand, so thus from a booming global economy, and especially the biggest oil consumer nations like China and the US, that is usually a good environment for oil prices to move higher. And vice versa, when the economy tanks, like we saw with the coronavirus worldwide lockdowns, that obviously sees a very big fall in global oil demand, which is obviously bad for oil prices. Moving on to something like geopolitics. So the Middle East is still a very important place in terms of oil, even though the US and Russia is the biggest producers. Particularly, the most important place that we need to know from an oil point of view is the Strait of Hormuz. Now, the Strait of Hormuz is this little strait. If we have a look at the map, it's located between Oman as well as Iran. And why is this place important for us from an oil trading point of view? Again, comes back to supply and demand. According to the EIA, which is basically the US Energy Information Administration, about 21% of the world's oil moves through this little narrow 21-mile corridor. Now, this is particularly important because of which country sits on the strait, which of course is Iran. So something that has recently surfaced again as a hot topic was the geopolitical tensions between Iran and the US, and of course, by extension, then Saudi Arabia as well. When tensions escalate between these three, we usually get threats from Iran that they will look to block the Strait of Hormuz, which of course has a big impact on supply and can affect short-term oil prices as well. So this is why the attacks on the Iranian general a while back by the US, as well as the reinstatement of sanctions on Iran from the US, has been a reason for some oil movements over the past couple of months. And again, the reason for it comes back to how it can potentially affect the supply aspect of price, and then of course how that affects the price. So if reports comes out that Iran has sunk a ship or captured a ship in the strait, or that there is military confrontations going on in the strait, that of course will see some upside potential in oil prices in the short term. So remember that name in terms of the Strait of Hormuz, very important from an oil point of view. Then moving away from geopolitics, we also have something like weather. So the weather, something like hurricanes and cyclones can also impact oil prices. So if we have a look at this website, which is Offshore Technology, here we can see, what type of effect something like the Hurricane Katrina, what that had on some of the oil rigs off the coast of the US. So if massive hurricanes hit parts of the world like these, you can also see that impacting oil prices. And again, the reason is supply, right? So if the market thinks that a hurricane will slow oil production in these affected areas, then that should be supportive for oil prices in the short term. And might even have a longer term or medium term impact depending on the severity of the hit, especially when you look at pictures like this. Now, apart from that, there's also other things on a weekly basis, like the inventory reports. So every week we get two inventory reports, one from the EIA and the other one from the API. Now, this is basically just inventory of crude stocks in the United States. So usually much bigger than expected draws, meaning less oil than anticipated in stocks is good for oil prices from a supply and demand point of view, and vice versa. When we have more stocks than anticipated, that's usually referred to as a build that can see some oil downside. Now, just keep in mind, even though that is generally the case, when there are specific catalysts moving oil prices like global demand issues or big OPEC announcements or big overall risk sentiment flows, things like inventories might take a back seat compared to those overarching themes. So why is all of this important to us as a FX trader? Of course, due to the strong correlation between petrocurrencies like the CAD, the NOK, the ruble, with the oil price. So if we just go back to the charts, let's just get WTI on here. Or you know what, let's take the CAD yen. If we take the CAD yen and we just compare this to WTI, we can of course see that very strong correlation between the Canadian dollar as well as the oil prices. So our petrocurrencies like the CAD, the ruble, the NOK, always going to have a strong correlation to the overall movements of oil prices, and that's why it's important for us from a currency point of view, because these types of movements in oil prices, massive shocks in the short term, can create great trading opportunities for us from a CAD, NOK, and ruble point of view. But of course, you can also trade this in the short term by just trading oil prices itself. But as we said, that's not really our specialization. That is more on the on the FX side. So the big question then, do we sit every day and go through OPEC reports and look at confrontations in the Strait of Hormuz or look at weather patterns? Of course not. There's no time for us to do that. If you want to be a real oil trader, then by trade you'll need to do all of those things. But we do have a great little shortcut, of course, which is the Forex Source terminal. So we don't have to go through all of those stuff. We can just focus on these things when and if the market focuses on them, when we see those type of OPEC or geopolitical or weather type of announcements popping into the terminal, we know that's going to be positive or negative for oil prices based on the type of event that it is, and we'll immediately know when it can, respond accordingly to movements across CAD or across the ruble or across the NOK. So a great way to take advantage of all of these type of features is just by following the squawk itself. So the moment when something big hits the wires from an oil point of view, you'll see that dropping into the feed, and of course you'll be able to react to that quite quickly. If you get it over the audio squawk. So Sakim, there was a little bit more of a detailed look into oil prices. So I hope that helps. If there's any questions after this, please let us know.